More than $3 trillion gone. Not over weeks, not over months, minutes. Gold collapsed, silver snapped. Screens turned red so fast that most people didn't even have time to react. Somewhere right now, someone is staring at their portfolio, refreshing the screen again and again, trying to understand how something that felt so safe just hours ago could suddenly feel this fragile. A position they were confident in is now deep underwater, and the worst part isn't even the loss, it's the confusion, because nobody explained why. Mainstream headlines are already rolling in. They're calling it normal volatility, a healthy pullback, markets digesting new information. But here's the uncomfortable truth. This wasn't random. And it wasn't just volatility. And if you don't understand what really caused this crash, and more importantly, who benefited from it, you're at serious risk of being on the wrong side of the next one. By the end of this video, you'll understand exactly how $3 trillion disappeared, why gold and silver were hit so violently, and why the people who lost money weren't the only participants in this move. Because whenever trillions vanish this quickly, they don't just evaporate, they move. And the question you need to ask yourself is simple. Did your money disappear or did it end up in someone else's hands? Stay with me. This matters more than you think. If you've been following the coverage, you've probably heard a familiar story. Markets were overheated. Traders were taking profits. Uncertainty created temporary instability. That explanation sounds neat, comfortable, reassuring, but it completely ignores the structure of how modern markets actually work. Markets don't move like this fast, this aggressively, without pressure building underneath. Pressure that only releases when something breaks, and when it breaks, it never hurts everyone equally. Some people panic, others prepare. And a small group profits quietly while the rest argue about headlines. The first mistake most investors make during crashes like this is assuming everyone is experiencing the same thing at the same time. That's not how markets function. Retail investors react after the move begins. Institutions position before it happens. That difference, timing, explains almost everything. Gold and silver aren't just assets. For many people, they represent safety, stability, and insurance against chaos. So when these markets crash, it hits differently than a tech stock pulling back or crypto swinging wildly. It feels like the ground shifting under your feet. And that emotional response matters, because emotional reactions are predictable. Fear makes people sell too early. Relief makes them buy too late. Confusion keeps them frozen while others act. This isn't a flaw in human nature. It's a feature of the system. Markets are designed to move wealth from those who react emotionally to those who understand the mechanics. And today's crash was a textbook example. Let's get something clear right now. Gold and silver did not collapse because they suddenly lost value. Nothing fundamental about gold changed in minutes. Nothing about silver's long-term demand vanished overnight. What changed was positioning, and positioning is where the real story begins. When prices fall slowly, people adapt. When prices fall fast, people panic. That speed is critical. Rapid drops trigger forced actions, margin calls, stop losses, liquidations. Selling that has nothing to do with belief, conviction, or fundamentals. Selling that happens because someone has no choice. Once that process starts, it feeds on itself. Selling pushes prices lower. Lower prices trigger more forced selling. Liquidity dries up. Volatility explodes. This is how minutes erase trillions. But here's the part almost nobody explains clearly. Forced selling doesn't happen in a vacuum. For every forced seller, there is a willing buyer, someone with cash, someone patient, someone prepared. Losses don't disappear. They are transferred. To understand who benefited, you have to stop staring only at gold and silver charts and start looking at what actually moves them. Because metals don't trade in isolation. They exist inside a much larger system, one driven by currencies, interest rates, leverage, and liquidity. And at the center of that system sits something most retail investors barely watch: the US dollar. Here's a simple truth professionals understand instinctively. When the dollar strengthens, gold and silver struggle. When the dollar weakens, metals thrive. This isn't opinion, it's structure. Gold and silver are priced in dollars. When the dollar becomes stronger, it takes fewer dollars to buy the same ounce. Prices fall, not because the metal is weaker, but because the measuring stick changed. Think of it like a seesaw. The dollar sits on one side. Gold and silver sit on the other. When one side rises sharply, the other side drops fast. And in the hours leading up to this crash, that's exactly what happened. The dollar didn't drift higher, it spiked, quietly, relentlessly, while most people were focused elsewhere. By the time gold and silver reacted, the move was already underway, and the people watching the dollar saw it coming. Retail investors tend to watch the asset they own. Gold investors watch gold. Silver investors watch silver. Professionals watch the inputs. They monitor currency strength, interest rate expectations, and liquidity conditions, because those are the levers that move everything else. By the time price reflects those changes, the trade is already crowded, and during this crash, that difference in perspective made all the difference. But the dollar wasn't acting alone. No major market move has a single cause. Big crashes happen when multiple pressures converge. This one had three. Each alone might have caused a dip. Together they created a cascade. First, monetary signals shifted. Markets reacted not just to what central banks did, but to what they signaled. Rate expectations hardened. Inflation concerns resurfaced. Uncertainty increased. Capital moved defensively, toward the dollar and away from assets that had already rallied hard. Second, leverage played its role. Silver is inherently more volatile than gold. It moves faster in both directions. What looks like opportunity on the way up becomes danger on the way down. Forced liquidations amplified the move. Third, timing mattered. This didn't happen after a long decline. It happened after a strong rally, when confidence was high and positioning was crowded. Crowded trades are fragile. Once the first domino falls, the rest follow. So who really profited? Not the people panic selling at the bottom, not the ones staring at red candles in disbelief. The winners were the ones who understood the setup before it played out. They watched the dollar strengthen. They reduced exposure quietly. They held cash while others chased momentum. And when forced sellers hit the market, they stepped in, calmly, deliberately, without noise. This is how wealth transfers happen, not with announcements, but with preparation. If this feels familiar, that's because it is. Markets don't change nearly as much as technology does. Human behavior doesn't change at all. Fear still causes panic. Greed still fuels bubbles. Leverage still magnifies mistakes. Every major crash follows the same emotional arc: confidence, complacency, shock, panic, and regret. The only difference is who recognizes it in real time. After the crash, the same questions always appear. Is this the bottom? Should I sell now? Is gold still safe? Is silver broken? These questions are natural, but they're reactive. Smart money asks different questions. What conditions caused this? Have those conditions changed? Is this a reset or the beginning of something larger? Those questions don't lead to panic. They lead to planning. Here's the insight most people miss. Crashes don't end trends. They test conviction. In strong trends, crashes shake out weak hands and reset leverage. In weak trends, they expose structural cracks. The difference matters, but you can't see it clearly when emotions are high. That clarity comes from context, not price alone, and that context is what we're building right now. In part 2, we'll step back and look at history, because this exact setup has appeared before, and when it does, the outcomes are extreme. We'll break down the two realistic paths forward from here. We'll talk about what this means for you, whether you're holding, waiting, or questioning everything. Because what happens after crashes like this is where fortunes are actually made or lost.